Hello, everyone. Good evening. Is it working? Hello, my name is Karen Tucker, and I'm CEO of the Churchill Club. Welcome to our program. We shall get started. I'm happy to see lots of our members in the audience tonight, as well as some old friends who are returning after being away from us for a while. So welcome back. We're very glad to have you. How many first-time attendees do we have in our audience? Terrific. Welcome. Churchill Club is a member-supported nonprofit organization, and if you enjoy tonight's program and you're not a member, I do hope that you'll consider joining us. We have both corporate and individual opportunities for you and a little bit of insider information. Sometimes if you call our office, they'll have membership specials for you. You can also check our website, churchillclub.org. Our program tonight is called Venture Capital Roundtable 2011, and we have an amazing group of speakers. I'd like to welcome Howard Hartenbaum, Josh Kopelman, Bill Maris, Ray Rothrock, Aydin Senkut, and our moderator, Steve Bengston. Thank you all very much for being here. And I would also like to thank our program sponsor, Fenwick & West. And a big thank you also to Microsoft for hosting us. We greatly appreciate your support, and we couldn't have done it without you. Please join me in thanking our supporters. And also a grateful nod to Google Ventures, Felicis Ventures, and Shernaz Daver. A few other announcements. Next week on June 21st, we present a Churchill Breakfast Club program called the Fully Social Networked Organization, with the inside scoop on how organizations are now using social media for maximum returns. Our speakers are from Cisco, McKinsey Global Institute, and ARM. And as an attendee, you will receive a complimentary copy of Moderator Larry Weber's new book entitled Everywhere, which is about social media business strategies. And then on June 29, we present a premiere event with Ursula Burns, Chairman and CEO of Xerox, recently named the 9th most powerful woman in the world by Fortune magazine. She was raised by a single mother in a housing project, and she started as an intern at Xerox. She has a fascinating story. She will be interviewed by George Colony, the CEO of Forrester Research, and I do hope you'll come and meet Ursula and George and hear their personal stories and their thoughts about leadership, the markets, innovation, other topics. And for a limited time, we are offering you the opportunity to purchase a ticket to this event, and we're encouraging you to bring your daughter for free. Just contact our office and we'll set that up for you. I think it's really an extraordinary opportunity, so please make it a point to attend if you can. We have lots of other programs in the works for you, including Jeff Weiner, CEO of LinkedIn, and Ari Emanuel, co-CEO of William Morris Endeavor Entertainment. And that program is called A Talent for Talent, and it will be held on July 18, not yet announced, except for here. And the first annual Churchill Club Awards will be held on September 15. Both of these outstanding programs will be available for registration shortly. Please bear in mind that we are on a roll, so keep an eye on us. There's a lot more to come. And my last announcement, there are Twitter codes in your printed programs. If you're tweeting tonight, please do use hashtag Churchill Club. And now, it's my pleasure to introduce our moderator, Steve Bengston, who will then introduce our speakers. Steve is Managing Director of Emerging Company Services at PwC, and he is also the esteemed chair of the Churchill Club Board of Directors this year. Aside from the world of business and technology and the Churchill Club and, of course, his family, it turns out Steve loves coaching kids' sports, especially b-ball. And he says he's still trying to figure out how to make a living doing that. Let's give our warmest welcome to Steve Bengston.
Thanks, Karen. Can everyone hear in the back? Okay. The format for tonight is I'm going to give a very brief summary of kind of stats and what's going on in the venture industry, and then each of the panelists is going to summarize the issues that they see going on either in the venture community or the entrepreneur arena or anything that might affect that market. And we'll take questions from the audience at any time. I'll keep, after each of the panels is done, I'll start firing away questions till we see audience questions. So if you have something, raise your hand, get our attention, throw something at us, and we'll try to answer your question. With that, let me give you a quick summary of kind of the state of the industry and evolution for those of you who aren't that familiar. The venture industry has been around for roughly 50 years, 50. In the U.S., it started in Boston. Boston was the mecca for 20 or 30 years, depending upon how you define it. And it slowly migrated west to Silicon Valley, which has been the mecca now for 20 or 30 years and is firmly in place as the mecca for venture capital right now. But it's a volatile industry. Give you a sense, after 20 years, the entire industry in 1980 invested $1 billion the whole year, all VCs. That was only 30 years ago. I suspect if we polled the panelists, there's probably been a year or two in the last couple of years where just these 5 firms invested $1 billion. Or at least something there, and that's roughly the size of the whole industry was 30 years ago. Fast forward 10 years to 1990, the industry tripled, $3 billion invested. We thought it was huge. Fast forward another 10 years, increased 30-fold, $100 billion got invested in 2000, and probably $98 billion of it got invested wisely, maybe. And then 10 years later, it shrank by a factor of 5. So now it's roughly $20 billion. So depending upon whether you think the world is half full or half empty, it's either 1/5 the size of 10 years ago, what's wrong with it, or it's as big as anything before 1998, and we thought it was big back then. So a lot of money by historical standards, but not by the level of 2000. There's a reason we're meeting here. 40% of the money gets invested in Silicon Valley. Another roughly 10% gets invested in Southern California. So California alone represents 50% of the VC investment in the U.S. And in fact, Southern California is roughly tied with Boston and New York for second place. Each of them are about 10%. So the top 4 markets in the U.S. account for 70% of the venture investment in the U.S., pretty dominant. The good news is the U.S. continues to lead the world in venture funding, in company formation, job creation. I mean, the rest of the world really is trying to copy Silicon Valley, and we probably will talk a little bit tonight about how well they're doing. Some places are doing better than others, and how soon are they a threat to Silicon Valley's dominance? But on the other side, the venture industry really is in disequilibrium. It cannot stay the way it is. Because in the last 2 years in the U.S., the industry's invested $10 billion more than it's raised. And even in the magical world of venture capital, that can't last forever. And we're likely to do it again this year. So it's going to be roughly 3 years in a row that we've invested $10 billion more than we've raised. So something something's wrong. Exits don't support the current investment levels at $20 billion. The money won't get there, which is why returns have been bad. So either investments got to go down, fundraising's got to go up, exits got to go up, or some combination of all three. Cannot stay the same forever. Historically, IPOs have been the dominant exit till about 10 or 20 years ago, and then it completely switched, where now I think M&A outpaces IPO maybe 10 to 1, 15 to 1, and it was exactly the reverse 20 years ago. So it's amazing how quickly and how dramatically that changed. And in the last 10 years have not been great. The median returns for the venture industry have been negative every vintage year since 1998, every year. And the average median return for the industry overall has been roughly negative 5% a year for the last 10 years. So, that's not good for the LP community. The top industries, if you just look at where the money's going in order, are software, clean tech, biotech, and med devices. A lot of money going in all 4 of those. But if you talk to a lot of the investors in at least 3 of those categories, clean tech, biotech, med devices, a lot of concern about the viability of those sectors, how big they should be, whether they're too big now, where the exits are going to come from, and those are the industries getting a lot of money. So many commentators feel that the venture community has moved later stage and has somewhat abandoned early stage. In fact, some prominent VCs are investing in private companies on secondary markets at valuations in excess of $20 billion. which moves somebody to comment, "I don't know what that is, but it doesn't look like venture capital to me." So in summary, in the future, will future VCs look more like mutual fund managers, or are they going to look more like the VCs in the past? Have innovation and risk-taking given way to caution and lemming like investing? Fortunately, our panelists have all the answers. Starting with Howard Hartenbaum from August. Howard, you want to give your thoughts about what's going on in the world?
Based on all of those comments, that's quite a bit. I'll raise something along the line just to spark some additional conversation, which is one of the biggest challenges in the venture industry is something that hasn't changed over time, but it's consistent, and that's that the feedback loop to determine if an investor or a firm is any good is too long. So if the average time, this is another issue on top of the issues that you raised, if the average time to exit right now, I believe, is 9 years on average. Some are quicker and, of course, some are longer. And somebody enters the business and they do roughly 1 or 2 investments per year, they could literally go 10 or 15 years without knowing if they're any good at the business. And equally complicating is that if a new firm is started with a few investors in it who haven't had experience in knowing if they're good before, and LPs invest with them, and then they invest with a follow-on fund a few years later, you can be 10 years, 12 years into the business and look at yourself in the mirror in the morning and say, wow, I didn't do a very good job. I didn't make money for my investors. And that feedback loop, I think, is one of the biggest challenges that we face as an industry, because the LPs keep piling money into investors and firms who haven't performed over a long period of time. And that cycle just keeps continuing, and I think that's one of the roots of the issues that are here.
And even more perversely, if you're in a large fund, you might go 10 years and make an awful lot of money on fees, never have a good deal. You actually think you're good because you made a ton of money, but the LPs are wondering where your first exit's going to be.
Yeah, I think that the GPs who look themselves in the mirror and say, I made a lot of money on fees, but I didn't make money for my LPs, they know that they should be, they're embarrassed. I mean, they're looking at themselves and saying, I know I worked hard and I did the best I could, but I lost money for the past 10 years. And
I'm sure looking in an expensive mirror.
Yeah, which is a related issue.
So Howard, could you go a little bit in your background? You actually started, I think, at Hughes Electronics, which has not historically been a real starting point for a lot of venture capitalists. How did you migrate from Hughes to venture?
So that was a great training ground for the venture business, because my job at Hughes was in technology licensing, and I worked for Hughes Research Lab, which had 400 PhDs based in Malibu. And they wanted to make money off of their technologies, so I lived in Japan and traveled throughout Asia talking with a variety of companies saying, we have this networking technology or this battery technology or this whatever technology to do licensing deals. And in our business now, I mean, all of us, we look at deals every day that come in, and there are a wide variety of technologies. And the more breadth you have in looking at them, I mean, maybe I'm this wide but this deep in them, at least I have some experience with those technologies and then know where to start and do some research about them. I got into the venture business. I was at a startup company, and I was pitching to Bill Draper, who's one of the grandfathers of the venture industry. And he looked at my company, and this is in the middle of 2001, and he said, I don't think that company is going to make it. I mean, the river is flowing strong, and you're just a little fish trying to swim upstream. Nobody's going to, IBM's not going to buy from you. And most of your customers are other venture-backed startups, and they're going to go out of business. Now that I've beat you up, why don't you come and work with me? And I looked at Bill and I said, well, you look like you know what you're doing, and your office is nicer than mine. So I found a replacement for myself at this company, and I joined Bill. So that's how I got into it.
Thanks, Howard. Now, next up is Josh Kopelman from First Round Capital. Josh wins the award for biggest commute today, coming from Philadelphia. I think everyone else was able to drive here. So, Josh, why don't you give your thoughts about what's going on in the world?
So it's interesting because to some degree I think what we're seeing is back to the future when it comes to fund sizes. If you were to take the first funds, so the first fund that Kleiner raised, Sequoia, Excel, NEA, TA, CRV, and Mayfield. So those 7 funds, if you take their first funds and combine them, combined, all 7 of them raised combined under $150 million. And then you could say, well, it was years ago. So if you inflation adjust it, the average fund is still around $50 million. And now you're seeing all of those funds, are managing, billions. And, I think part of what's happened is, as an asset class, economists talk about asset classes trying to find their natural limits, right? So as asset class will sort of perform, and people will put money, and it would perform, and people will put money, but there's a cause and effect. And as you've talked about, sort of the performance of venture as an asset class, we've now finally, for the first time in history, once we left sort of the 99, 2000 area, we've now crossed the first time where the 10-year number has actually dipped negative, which means that the average venture fund has actually lost money over that 10-year period.
Yet the LPs keep throwing a lot of money at it.
But I think, yes, but I think you're seeing the emergence of a new class of funds. So here's where I sell my book, and I'm talking in a self-serving way, but like sort of micro VCs and seed funds. And, Silicon Valley Bank came out with a study last year. And what they did is they looked at about 850 venture funds over from 1983 to 2003. So they looked over a long period of time, a 20-year period, where you had ups and downs in the cycles. And they looked at 850 funds, so it's pretty exhaustive in a broad study. And each year, 83, 84, 85, they said, what was the median venture fund size raised? So in 83, maybe the median fund size was 150 million, and they basically said, all right, well, if you're over the median, let's call you a large fund, and if you're under the median, let's call you a small fund. So they didn't pick an arbitrary limit for the fund size. They said, let's take a look at the median. And now the reason they stopped in 2003, they went 83 to 03, is because they want to look at performance. So they needed to cut back to have some performance. And if you look at all 850 funds over that 20-year period of time, and you look and say, all right, of those large funds, just the group that's above the median, what percent of them return north of 2x over the entire life of the fund? And I was shocked to learn that the number was 2%. So 98% of the venture funds that were raised that were above the median, not an arbitrary number, but just the median of their group, 98% of them didn't even double. And if you look, and north of 60% of them didn't even return capital. Now, if you look at the smaller funds during that same period of time, just the ones below the median, 48% of them had north of 2x. So a fund was 24 times more likely to double capital or more if you were smaller than if you're bigger. And less than 20% of them didn't return capital. So again, it's just one data point, but I think it's healthy. What you're seeing now is that the market is trying to find its equilibrium. So as money flowed in, performance went down, and now money's leaving. And I think you're seeing two things. I think you're seeing a reduction in money, which is good. I think every venture capitalist will tell you there's too much money going into venture, and a lot of funds around shouldn't exist. Now, they'll all say that they're one of the funds that should exist. And the second thing that you're seeing is not just a shrinking in money, but a shrinking in fund size, which I think also is really important.
Okay, thanks. Next up is Bill Maris with Google Ventures.
So I think there are some macroeconomic trends that you haven't talked about over the last 10 or 12 years. If you look at what's happened to the housing market or to just the S&P 500 over the same time period, I don't think any of the performance of any of those asset classes would dazzle us. So I don't want to sort of highlight venture as being incredibly disappointing by comparison. And
I know Google affected the housing market in my neighborhood.
I don't know whether to say you're welcome or apologize. I think sometimes a mistake is made when we conflate IPO with exit. Certainly for venture capitalists, an IPO can be an exit, but an IPO is really another fundraising round for a company. So the health of the startup ecosystem is not measured solely by IPO activity. And in my experience over time, we don't really look for entrepreneurs that are sort of the first question out of their mouths is what's the health of the IPO market or M&A activity. That's not really what the business is about. And so when there's a lot of talk about how hot the IPOs are or are they going to pop, but that says that the pendulum has swung really far in one direction. And so when $100 billion a year is going into the venture industry as opposed to $20 billion, say, this year, I mean, this is all a business cycle, and we can argue if at the ends of that cycle if it's irrational, but the pendulum does usually swing back. And someone said, I can't remember who, that sometimes that pendulum will crash through the drywall on one side or crash through the drywall on the other, but it does swing back. And so I don't think it's not as fantastic. In 1999, it wasn't as fantastic as everyone thought it was, and it's not as horrible now as sometimes it's made out to be.
Thanks. Bill, you started in life sciences, and now you're in Google Ventures, which, as far as I know, doesn't do a lot of life science. So how did you make that transition?
So I started out, I got a degree in neuroscience, and decided it's a history of being in the right place and trying to find at the right time, but also trying to find an opportunity that matched with my short attention span generally. So by the time I graduated, I thought, well, I don't want to pursue a PhD anymore or an MD. So I did a little research and then decided to move to San Francisco. Saw the startup ecosystem out in the Valley, but then was offered a job in New York City as a portfolio manager to run a biotech and healthcare portfolio for a Swedish venture fund, a private equity fund called Investor AB, who I was the second American to work at the company. I somehow managed to dupe them into thinking that I was qualified for the job, and I and a partner ran their healthcare investments, which at that time entailed going to a lot of scientific conferences and learning about drugs that were being developed and helping to kind of interpret some of that data. And they gave us more and more responsibility, and that was the mid to late 90s, and the internet was starting to take off, and it became clear that doing this job and making a lot of money for someone else as low man on the totem pole was not going to be very much fun. So I decided to start an internet company of my own, and that the rest is history.
I think Google Ventures was in the paper today for a number of clean tech investments, which are pretty different from your core business. What are the themes that you guys focus on?
So I'll make the distinction because it's important. So Google was in the news today for Google Inc., which is our LP, and that isn't a semantic difference. So Google Ventures is a separate entity with our own management structure. Google is our sole LP, but Google is involved in a tax equity investment with Solar City, I think is what you're referring to. So that's a Google Inc. Sort of activity that we're aware of and we talk about, but that's sort of up to them. And then there was other news as well. I don't know if you're talking about that.
Okay. Well, thanks. Next up, Ray, I think you qualify as our grizzled veteran on the panel. Ray Rothrock has been in the venture business a long time with Venrock, which is one of the oldest firms.
You're right. I pitched Ray in my first startup in 1993. Right.
How'd it go?
I didn't get a turn.
Is that why we have Bill in between you?
Actually, though, now we'll do anything Josh does. So just come. So a couple of observations after 23 years of doing this. It's still a lot of fun. It's harder than it's ever been, and I think the big factor is time. And there are a couple of dimensions of time in this business that matter. And the average holding time's been as low as 3, as much as 9. It's just all over the map. But the real problem is that the time that this business, the money cycles through. And let me give you some examples. So, for example, when I got in the business with Venrock, it was an evergreen fund. No fundraising. You needed cash, you go to the Rockefeller family, you ask for cash, they give it to you. Every year you sit down, you tell them what you did with the cash, and sometimes you returned a bunch, and sometimes you lost a few dollars. But it was a good process. And you weren't under any constraints to force a company to liquidate or exit sooner than it was ready. And also you weren't under any pressure to invest. So the fact that entrepreneurs, like then they are today, they're still entrepreneuring. There's ideas, all the time. And I think this industry is witness to the fact that there's a massive amount of entrepreneurial ideas and opportunity. But the time factor has been crushed. And how's it been crushed? Fund cycles now are 3 years. They're not 10 years. Let's not kid ourselves. You got to have results in 3 years. Well, if you've ever done a startup, and I have, and I think a lot of the guys on this panel have, 3 years is a blink of an eye, and you might figure out where the bathroom is. So it's too short. I think that was brought up earlier. It's just too short. You can't measure people properly. You force artificial measurements on people. And surely to construct an exit of any meaning that might prove you're a venture capitalist or even prove you're an entrepreneur is very, very hard to do. So in the cash-on-cash world, it was a very different thing, but it's moved to an IRR world. I chaired a $1 billion foundation's investment committee for 4 years. I feel sorry for the guy that followed me because I was there during the last 10 years when the returns were zero, but it's kind of when venture became an asset class. So there's a bunch of guys that have that position now that are looking at the last 10 years saying, what was that idiot before me thinking when he invested in all those assets in venture capital? It was stupid. And so unfortunately, I think there could be a backlash because foundations and hospitals and all those groups provide a lot of the, universities provide a lot of the capital. And so 10 years, it's pretty bad. So the new people are going to say, out of here. In fact, I know of because I'm sort of connected to some of those folks, they're actually taking it off their balance sheet as an asset class or combining it with other things. And so it's kind of getting mushed around. So I think time is a real problem. The other thing about time is to really build a big, successful company, it takes 20 years. To get a drug approved, it takes 20 years. To build anything, it takes 10 years to even sort of get on the map and another 10 to really dominate and be big in your industry. So unfortunately, we're measuring entrepreneurs, we're measuring ourselves, and our LPs are measuring us in a very short time frame. So I think that creates all this artificial pressure that is not going to be good for the industry. The other thing I'll say, and I think it was Josh brought it up, that small is good. I mean, Venrock in 1988, our balance sheet was $50 million, $50 million. It was evergreen, so we'd have an IPO and it'd swell to maybe $100 million, and then we'd distribute that and it'd be back to 50, and it sort of oscillated in there. So we looked great for a long time, but then to build a really great big company, we had to have more capital, so we raised more capital, we got big. Then we had to have not just one IPO every couple of years, we had to have 5 IPOs every year, 8 IPOs every year, 15 every year. That's what it was like in the late 90s, and that is a hard pace to keep up. It's hard to find those deals. It's hard to find entrepreneurs who know how to build those deals. But the time cycle, so I think time is a funny thing. And if I had to do it all over again, if I were going to go out and start a fund today, Rothrock Ventures, I would do it as an evergreen because it gives you the freedom to invest in people with long-term visions, short-term visions, need for lots of capital, a little capital. It gives you flexibility that I think the institution, the asset class has taken out.
Thanks, Ray. Next up is Aydin Senkut with Felicis Ventures, another Google veteran. Aydin.
Thanks, Steve. So I'm going to pick a different tangent. So I came to Silicon Valley 15 years ago, and I actually started in hardware. I worked for a company called Silicon Graphics, which some of you might remember, some of you might not. And the interesting thing, kind of going on some of the different tangents, that was the time when I think early 90s, all these great hardware companies came about. They were the heroes of the tech industry. And then the next wave was enterprise software. And so these established software became the new norm and the big giants. And everybody thought, well, this is as big as it's going to get. Then the internet came along and Netscape and Yahoo. And I was right there when Netscape and Yahoo went public. And I thought, oh, my God, I'm such a loser. I came to Silicon Valley right after these big IPOs happened. I completely missed the boat. And then through my connections through SGI, I ended up being one of the early employees at Google. And Google became an incredible company. I mean, we got to $1 billion revenues in 6 years when IPO. It's became a $100 billion plus company, record time, right? I mean, it feels like, my God, it's been 11 years, but it felt like a huge ride. And now there is a new wave, social networking, and that's maturing with Facebook and LinkedIn. And there will be more waves coming in. And I think one of the things to think about as human beings, we're not very good at exponential thinking. We're always in incremental, and we always kind of look back to the past and try to extrapolate from that. And because of the long tenure of these firms, that's what happened. Suddenly, the people that made incredible investment decisions in hardware firms were not equipped to make that for software or internet. And the people that made the internet calls didn't necessarily always caught onto new waves like social networking. It sounded like kind of a nice to have, like maybe the next dating site or whatever. They didn't really understand the fundamental change that would bring. So certainly I think that's worth bringing about. I think the nature of the venture firms are changing. I mean, my background is probably the most similar to Josh. I left Google. I thought for 6 months what I was going to do, and I realized that all my experience and contacts was in tech. Talked to a bunch of venture firms and realized that I didn't really fit the bill. And one of the partners told me that I really didn't fit the bill, and why would I be a venture capitalist? And I thought maybe I'll show him how to be one, and by just doing it. And I think that was the best way. And I became an entrepreneur just like the entrepreneurs I support. And that was an incredibly insightful way of understanding that venture capital is all about finding your niche and also finding great founders, relating to them. So definitely this operational experience is really important, and that's one of the things we're seeing about the next generation of venture capitalists. And then another thought, just to kind of conclude, when I talk to people, I don't think they really understand that things are accelerating. People are always thinking, oh, it's boom or bust, boom or bust. Not many people are thinking that things are fundamentally changing. So it took Google roughly, somewhere around 6 years to get the $1 billion in revenue. Groupon did that in 2.5 years. There might be some other company that might, come up with such an incredible technology that is life-changing. Not necessarily in internet. It could be something in health or some other area that could become really big instantly. So I think it's just something important to keep in mind. And whereas most of the attention of venture capital industry is focusing on a very small area in this whole internet and media aspect because of this kind of quick notion of how fast things turn around. And one of the ways it has impacted, I think, companies like Facebook and Twitter accelerated the dispersion of brands and if something is good or bad, and it is also playing a role in venture capital. I think 10, 20 years ago, people just went around Sandhill and knocked on people's door. Hey, I need some money. You're a good firm. I'll talk to you. And firms received entrepreneurs, and then if something's worked out, they did the deal. Today, more than 80% of entrepreneurs that I talk to have checked me out on the internet. They read my blog. They looked at my Twitter stream. They already checked 5 entrepreneurs that might or might not work with me or know me. So it is drastically different, and all that stuff is changing fast, and it's probably going to change even faster, and it is affecting the outcomes, and that's where I think we kind of go back to the future, and but there's yet more interesting things to come.
Thanks, Aydin. Let's help our audience a little bit. I'm sure we have some people out here either raising money now or will be raising money in the near future. In fact, we'll probably be raising money about 8:30 tonight, talking to you guys. Fundraising is always hard. We send a disproportionate message to the world through the press and other contexts because all we talk about really are the successes, and it seems so easy. But the harsh reality is less than 1% of people that try to raise money raise anything. So it's always been a brutal business. It's still a brutal business. And we just said, here are people, we've got 1,000 people that their goal is to invest in companies and raise money. And for a decade, they've lost money. And these are the best people in the world at doing it. So it's a hard business. It's hard to know the right companies. It's hard to make money.
So I think it's unfair to lump all venture firms as an asset class together and just say that we lost money. And I think that the majority of people on this board have, if not all, have made money in the past 10 years. Yeah. And an interesting piece of the venture business is you can say as an asset class it lost money. That's because the top 20% of the firms made all the money and were consistently profitable for the past 20 years. So I think it's a little bit unfair to just make that statement.
I think as a Googler, I guess I'm sort of data-driven, and as everyone was talking, I was thinking, I haven't looked at the data, so I don't know for sure, but maybe Josh has, that if you looked at the top 5 or 10 venture funds over the last 10 years, I wonder if they made money.
Oh, of course. There's real network effects.
Right.
In
So
this
I would imagine that others are chasing. Is money still going in? Well, you can get lower carry and fee structures. So if you're a potential LP, you say, well, I can't get into a Sandhill Road Fund X because it's closed to me, but I can get into this other fund and their fees are lower. Their performance might be lower as well, but that's it's not. The average isn't important. It's sort of the top decile where all the performance is, and then people chase that, I think.
Yeah. The average in the venture business is not a good strategy.
Correct.
So we got a lot of people trying to raise money. What tips do you have for people that are trying to do it that aren't obvious? What do people do to raise money from you that you can give advice that that a reasonable person might not think of?
Well, I was asked recently how many pitches I'd seen, and so I sat down and did some calculations, about 10,000 formal pitches in 23 years. And I would say the best pitches are the shortest pitches, to the point pitches, answer the question pitches, and don't forget to put your financials in there. At the end of the day, it's about finance. And if you're going to be around a long time and build a big company, you will have to have a balance sheet and income statement and cash flows. But really, it's the credibility of the team, the macro set. investing in slideware is risky, but again, it's about people and the opportunity, and if you can see it come together. I'd say the big failure is to not answer the question, sort of to meander and walk around, It's just, if it's a yes or no, answer it yes or no. And say, I don't know if you don't know, because we're just trying to assess risk. We don't have all the answers. We're just trying to know whether you know the answers or not. And if you don't know the answers, well, that's okay. We'll figure it out together if we like what's going on. So, the best pitches are the shortest pitches. And if you're told you've got 45 minutes or an hour and a half, whatever it is, think about it, stick to it. And just like Aydin was saying, know who you're pitching to. You should know pretty much where they live, their dog's name, where their kids go to school, all that stuff.
Just don't visit us.
That's right, yeah. Well, except through Google.
Right.
I could come down and visit your house. But seriously, know who your audience is. I mean, if you've been to Sales 101, Xerox, or IBM sales training, they will tell you. Know who you're pitching to, know what the hot buttons are, know what vocabulary they don't or don't like. There was a time in this business when it was sort of left over from the 60s, the initials VC did not mean venture capital. And it was a negative term. You did not use it. It got people upset. So you need to know these things as you talk to these people.
So I think what I would expand on that is, so my favorite term to use is positive bias. So I think one of the best things you can do is try to create a positive bias for the people you're talking to. A lot of times, I think founders, being as excited as they are about their companies, kind of go through a standard list of investors. Okay, here's the best known ones, or here's what people told me to speak to. But they don't necessarily make the connection of, for whatever they're doing, are these investors the best match or not? Because at the end of the day, we're supposed to make decisions based on opportunity costs, what we know, and what our biases are. So it's an important job of the entrepreneur to network with the right people and create that positive bias. And not every time it's business related. Sometimes, like, you're a big biker, this investor is a big biker. Try to create a connection, because at the end it's personal connections. The second thing that I would say is one of the best advice that I heard from a great founder, CEO, as well as a venture capitalist is, one of the great measuring sticks for a company is what would you be saying to your 15th or 27th or 52nd employee to aspire them, right? The first few ones are easy because you can promise them a lot of stock. Oh, you're the founding employee, you're employee number one, you're co-founder. But what's going to happen when you get the employee number 20? What's going to inspire them? Are you going something that is a lot more than marginal and inspirational and big enough that whoever is going to come in, even at like employee number 120, wow, like that initial team is so great and this CEO has such a great vision, I want to be part of it even as employee number, whatever that number is. So I think that is a good yardstick, and that probably speaks for 15 other things I could be listing as factors. But I think being able to sell that vision of why this company is going to be big and important and critical and meaningful, and what value is it going to bring to its users is probably a good yardstick.
So to answer Steve's question, one of the not obvious things I think that entrepreneurs don't think about when they're pitching to VCs is, what does a VC actually want and what are they looking for? And what we're looking for is very large companies that come out of this. And entrepreneurs are thinking, I have this business idea and I want to build a company, and if you write your realistic projections down, even if you're optimistic, and you find that if things go perfectly, that you can generate $80 million a year in 5 years, there's not a VC on Sand Hill Road who will be interested in funding your business. It may be a great business, but it won't be an outperforming investment return, and we need both in the process. So if you're putting down what you think your company can be and you're excited about it, that even though it's a great company, it doesn't mean that we'll be excited about it in the process. If you're looking for venture capital to fund your business, if you can't convince yourself that it's going to be a really big company, then that's probably the wrong source of financing for you, and you should go pitch someplace else to get money, not pitching to venture investors.
So for me, there are two, I guess I was just thinking, there are two things that are kind of an immediate turnoff. I mean, you've got 45 minutes or an hour to pitch what are your hopes and dreams, and our job is to try and understand what that is and ask questions, and we see lots of these all the time, so we ask a lot of negative questions. What are the ways it can fail? Because venture capitalists don't love risk. I mean, and entrepreneurs shouldn't either. I mean, if you're going skydiving, you shouldn't love risk. You should want to minimize the risk as much as you can. You're taking a measured chance, and then you do everything you can to ensure that the parachute inflates or that the company is successful. So when I'm asking questions, or someone on my team is, if there's defensiveness or sort of negative attitude that comes back when you're pitching, we're trying to do our job, it's never personal. It's just we want to understand, and that negativity comes across, it can come across it can come across poorly because you focus on that rather than the content of the business. And the second thing that is always poorly received by me, at least, is if you're trying to game the system. If you have a term sheet and it's with one of these guys on this panel and you're just trying to up the price, we don't want the last nickel. I don't want you trying to get the last nickel. It's not about valuation. It's about sitting down across the table and saying, do you want to work with me for the next 5 or maybe 10 years to be on your board? And there will be times where we're going to disagree violently and things will be uncomfortable and the business is not going to always go well. It's not always a fun meeting. Am I the person you want to work with? If the answer is yes, let's come to reasonable terms. And if we can't, there's plenty of other people that might believe in your business, but don't take my term sheet and shop it because that makes everyone look and feel badly. It doesn't result in good companies either.
So I'll throw 2 things in there. The first thing for me is we see between 3,000 and 4,000 companies a year. So our first question is whether we're even going to take the meeting, just because we can't meet with everyone. So I think the source or sources of the introduction deliver a lot of credibility in terms of how we're going to sort of, who we're going to spend the hour with. And there are people that will send a deal where, without even looking at it, I know I'll take the meeting. And there are also people who send a deal without even looking at it. I know I won't take the meeting.
Just a couple names.
And I'm sitting right here.
The second thing is that I think that, so I'd encourage you to really think through the approach to everyone as well. And that doesn't mean that we funded deals that we found on LinkedIn and other things. That there are always exceptions. I'm just saying if you're trying to sort of figure out what increases the odds, the introduction is important. The second thing I'd say is that most entrepreneurs that I've seen, most successful entrepreneurs, share one trait in common, and that is they're good storytellers. Being an entrepreneur, you have to convince a lot of people that this crazy idea that you have in your head is a good one, and that what everyone thinks is is fiction, really is nonfiction, and you have to be able to sell a story that is able to entice employees, is able to attract press and attention, is able to attract investment, and weave this compelling and easy narrative.
Let's not forget customers.
And customers as well. When I look at, when we raised for half.com, our pitch was very simple. That was one of the companies I started. We said, let me ask you guys, how many people here have ever read a book by John Grisham, Danielle Steele, Stephen King, or Robert Ludlum? Raise your hand. All right, now keep your hands up. Keep your hands up. How many have read the same book twice? That was the entire half.com business story, to create a marketplace for these things. And we didn't say we want to create a person-to-person exchange for the high-volume resale of mass-market commercial printed goods. And we're sort of weaving that story and telling a narrative and making it personal. And I think that all too often we're sort of getting pitched buzzwords and we're not being told stories. Stories are seductive.
Chris Sacca, an angel investor I think most of you probably know, another ex-Googler, announced a couple months ago that he was going to have a personal freeze on his investments because he thought valuations were way too high. Do any of you share that concern? Have any of you scaled your investing down, and do you see valuations going down any time in the near future? Because I think since he announced that, they've gone up.
I passed on Twitter because valuation was too high, so go figure.
Me too.
How does that feel?
At the Series A.
At the Series A. So I think
I regret that choice now.
Yeah.
I think the idea is if you make a practice of overpaying, when you know prices are high, you don't know if they're extremely high, that they're higher than what we think of as normal. If you make a general practice of overpaying, you're going to lose in this business. If you can select the right ones, the price doesn't really matter, and that's the trick.
So I had the pleasure of working with Bill Draper, and he's been doing this for a long time. And at August Capital, the two senior partners there, John Johnson and Dave Marquardt, have been doing it for tens of years. And they all, in a similar vein, they all say the same thing, which is you can love any one deal and you can pay a ridiculous price for that deal and you'll probably lose your money, or maybe it's the one that works. But if you buy a basket of high-priced deals, you will lose money in venture capital. It's the way it is. Maybe you'll have one good fund, but over time, 3 funds, 5 funds, 7 funds. If that's your strategy, it doesn't work. And that's from people who are experienced and been doing it for, in aggregate, 80 years, 90 years.
And one of the few, they fall in that 2% of large funds that have actually made money.
And let's also highlight that when you say prices are high, I think you're talking generally about one vertical in the venture business, which is either technology and or social media. There's one vertical where everyone talks about prices being really high, but in life sciences or other businesses where sometimes it takes a lot of time, you need PhDs, people need to work with real world atoms and molecules. The prices aren't, the cycles are longer and the prices aren't as crazy.
So the other thing I would add is I think anybody that's only focusing on a price and time in isolation is, I think, should probably just think again in terms of their investment style. I mean, I think the best managers go way beyond that, and one of the reasons I'm saying is price is a factor of supply and demand. So just because there's high demand for a company and there's very little supply, that can completely affect the price. But then, I mean, a good example is I remember when I first left Google shortly after the IPO and Facebook shares first became available, like, $1 billion, like, is this a really interesting company, great company? And I should have learned from my experience, like looking at Microsoft in 95, thinking, oh my God, like, there's no way that the growth can continue. And when somebody has a really solid business and a really good moat, what seems like very expensive can become very cheap in short term. And one of our goals as venture investors is to really understand those trends and to catch those. So I think part of it is, obviously it's important to get a price, and it's not like we're not going to do any deal at any price, but I think it's also our job to find opportunities wherever they are, where most of the people are not looking, and understand those factors and discover those businesses that will actually get to the point where those investments will be very attractive. And price is just one of the factors when, considering the whole package.
And I think high prices are a reflection of excitement and optimism around a certain type of company or a certain space. And I think we experienced it out here before dinner. I've said before that if everyone is at the sort of buffet and they're all at the entrees, maybe you should sort of look at the dessert table, because there are areas that are not overpriced and there are interesting companies out there, and they're not all in social media.
No, I agree. I mean, we're still pretty forward-leaning. I think Chris made those comments at the end of the third quarter last year, and I'd say the fourth quarter was our busiest quarter in our fund's 6-year history. So,
look, pricing is about risk. So the higher you start, the further you can fall. But if you have a good point of view about the outcome and it's big, then you can, the upside is multiple. So you can only lose 1 time your money, unless you reinvest and reinvest and reinvest.
The Kauffman Foundation recently published a study that claims that roughly 100%, all net jobs in the U.S. in the last 25 years were created by companies less than 5 years old. And a number of observers of the venture industry claim that venture industry is slowly moving more toward later stage and less toward early stage. Do you think that's a fair criticism? And if so, what, if anything, will cause it to move back?
I used to be a public market investor, and it's sort of like, should I invest in the S&P 500 or the Russell 2000? Well, over time, I don't know that it makes that big a difference, because I think that small company activity has a lot to do with big company activity. So I don't know the background data on how that stat was derived, but I can't believe that large company growth is divorced from small company growth.
I think partially what's reflected in that is 2 trends. Number one, I mean, one thing you observed initially is that fund sizes have become much larger. I mean, Josh made the observation, all these funds, even the Sequoias and Kleiners of the world, started as small funds and now are, running billion-dollar funds. And so when you're running a fund of that size, it becomes really, really important to make investments in companies that are very large in size. So I think that's one of the effects. And the second is, you have some interesting trends. I mean, you have a new entrant like DST coming in, and what initially was thought as a crazy valuation for a company like Facebook, and now is looking like a hero. And with all the pending IPOs now, after a huge drought, everybody's, I think, smelling the blood and seeing that there's an opportunity to make a lot of money in short term. And, it'll be interesting how those bets work out. So I think we're seeing also some timely trends in terms of where money can be deployed, and there is right now a huge interest in deploying huge amounts of money in these companies, and some of these companies also, because of extra regulation are delaying their IPOs, which means that they now have to raise money in public markets, which also open the door to secondary transactions in some of these companies, and they're not going public, which means that they have to raise more money, which actually, for a few hand-select firms, also brings up the opportunity to deploy larger amounts of capital.
So early-stage investors who become late-stage investors are driven by that clock that the LPs have put on their head. They're trying to get returns so they can raise the next fund. I really think that's a big driver.
Here we had our first burning question. The microphone is about to find you.
Carl Hewitt. I wonder if anybody on the panel can explain how Groupon might make sense and what the potential downfall is. Thank you.
Okay, Groupon, what do y'all think?
Do we have any Groupon investors here?
No, I'm not.
No.
Well,
I signed up and then discontinued it. It would just fill my inbox.
I'm a user.
I'm a Groupon shareholder because of a company they bought of mine. I mean, one can argue either side of it because I think they came up with a business model that really works fundamentally, which is, look, all the things that the small businesses care about is customers. Okay, one can argue it's too expensive way of getting it, it's not sustainable, all of that. But I think if you want to take one concrete example, and I'm not saying this is good or bad, the Groupon model, if you apply it to any country in the world, has had the exact same effect on revenues and exploded. In any country you take it, there hasn't been a single exception. So it's definitely unique, it's definitely exciting. Is it a good or bad or sustainable investment? I'm not going to make any comments on it because, like I said, it's got to $1 billion revenues in 2.5 years. We'll see how sustainable it is in another 5 to 10 years. Maybe it is, maybe it's not. But I don't think one can argue with some of the growth that they've been able to generate that has not been paralleled so far.
I'll make a comment, which is that fundamentally, if we go back to fundamentals, the value of a company, one could argue, is the discounted value of its future cash flows. And so all this tells me is there's huge optimism around what Groupon is or what it could be, I should say. And it was created in about 18 months to get to the point where it is. Could any of us imagine it disappearing in 18 months? Yes. That sort of worries me. Johnson & Johnson took 100+ years to get its massive footprint, and Groupon took 18 months, and it'll be hard to recreate Johnson & Johnson. So I'm not a buyer on the secondary market of Groupon because I'm not a buyer of individual stocks in that sense. That gets much closer to gambling than it does to investing.
I think it's a tendency of the press as well to, when somebody else is doing really great, to say negative things because everybody knows the concept of schadenfreude or meduta, which is the opposite. Schadenfreude is you take pleasure in other people's misfortunes. And people look at Groupon and they say, wow, those guys are all billionaires and all the guys who invested or so, NEA put in the first money and it's going to make their multi-billion-dollar fund. And a lot of people are just saying negative things about it because I think they're jealous. I was involved with Skype from the very beginning, and we dealt with that for years. People saying, oh, it will never work, it violates this law, it's a stupid system, the founders are criminals, all this stuff which just wasn't true. They were not criminals, they were honest, hardworking businessmen who were being screwed with by a system of some music companies. And they built a great company, and people said lots of negative things about it, and the proof is in they built a $1 billion company that made money and was a great business. And I think Groupon has the potential to be that. I think it's still early. I mean, they're still figuring stuff out, and they're dealing with the most astronomic growth that we've seen in a young company. And if there's smart people there, they'll figure it out. And if not, then it won't work out. But just to be a naysayer and say it's not going to work because I'm jealous of it working, I think is...
So let's just, if we anonymize and take sort of Groupon's name out of it, and one question I ask myself when you see a company like that is, if there had never been any press coverage of this company, what would the price be? And that's a way to sort of gut check. Does it seem reasonable? It may be justified, and you may look like a hero, but like I said, it edges closer to gambling sometimes than it does to investing, and that's when it makes me nervous.
And the question about Groupon is, in the long term, is it a business or not? Not now and not when they go public, but 3 years after they've gone public, have they grown? Have they crashed? What's happened? That a lot of venture investors measure the performance based on the exit price, but what really matters is, did the investors make money out of the deal?
Okay, we got our second question over here on the side, I think.
Yes, so my name is Rowan Wartenberg from Citrix. I have a question Recently, I talked to a friend who is a VC, and he said, don't trust VCs. They're like pirates. They just want to have your idea and then go away with all the money. What is your recommendation? Am I right? Yeah. What is your recommendation to an entrepreneur? Imagine that you raised money, timesheet is signed, etc., paper is signed, to be happy afterwards that the entrepreneur still thinks, yes, that was a good deal, and it's not just the VCs own the company and I do the work. What is your recommendation?
Is your friend on the panel? No.
I mean, look, let me make an indirect comment, and I don't know how you would expect us to answer this, but I think almost everyone on this panel, and I think we have a 23, 25-year track record, if you want to be in this business long term, you cannot do it by screwing entrepreneurs. Right. You could get away with it once, maybe a couple times, but like I said, the word is getting around faster than ever. So I think the way I'm looking at it, because like I mentioned, like Josh, I'm trying to build this business from scratch. If I don't delight the entrepreneur, just the same way of like, take the Zappos example, it became a successful company by making its customers very happy. So my longevity and success is going to depend on how well I do by the entrepreneurs. With that kind of a yardstick, it's going to be very hard for me to act against that, because the biggest asset that I can lose is my reputation and my brand. If that's gone, I should not be in the business. So I don't know.
Yeah, I think something else has changed in the last 5 years, which is the amount of transparency that we live in. Right? I know if I said something stupid or rude or offensive right now, it would be tweeted out on the Twittersphere. And there would be, millions of people retweeting it and hearing about it within 5 minutes if I said that right now. And I think the same thing happens now if you screw an entrepreneur, if you do something unethical, if you do something wrong. You live in an environment where there's far more information and people are far more accessible than ever before. So I think the environment really has a lot to do with how people commit.
Roger Ehrenberg just wrote a blog post sort of on this topic not too long ago. Entrepreneurs telling entrepreneurs not to trust or talk to VCs is as useful as me telling Josh, don't trust entrepreneurs, they're out to screw you. It's like, well, okay, then you don't have to talk to me, but you can talk to people that know us and sort of companies we've worked with, and there's two sides to every story. An entrepreneur who got screwed, there may be more to that story than what the entrepreneur is necessarily telling you. So, and maybe there's not. In some cases, there isn't. But it's not super useful to create friction when LPs, entrepreneurs, and VCs in a perfect system have they're all aligned in sort of what their goals are, to create a lot of value in the company.
Okay, next question. We got someone over here on the side.
Yeah, I'm curious. You initially talked about the 2% of large firms returning 2x and 48% of the small, below the median, returning 2x. So that's a big difference. I didn't really hear discussion why. Are the big companies swinging for the home run? Are the small companies taking much more intense interest in their investments and ongoing to make them successful? That's, I didn't hear why. Do you think the cause of that is?
Why do smaller funds do better than big funds generally?
I think it's the law of numbers, right? I mean, let's say that you have a $500 million fund and you own on average 20% of a company, so you can just make the calculation of how many YouTubes or how many Facebooks are you going to have to get, and that might be the only way to make that fund successful. You look at a $100 million fund, I mean, just even take a $40 million fund and just imagine that, you made some good investments and you're about to return $120 million in capital. At a $40 million fund, that will be a 3x. At a $60 million fund, that will be 2x. At a $100 million fund, that will be only 1.2x, and so on and so forth. So I think part of it comes down to math and what potential you have. And when you look at, and again, I don't know if there's firm data on this, but there's roughly about 15 companies that matter, 8 or 15, or take a number, a very small number that get to very large scale every year. In Silicon Valley, around the world. So that number has not changed drastically, might increase a little bit in the future, but if you have a fund size that is predicated on the fact that you're going to get to one of those and you're not one of those tough firms with a strong brand, the likelihood of getting there is going to be just mathematically very weak.
Okay, another question over on the side here.
Hi, this question is for Aydin. And I don't want
Hey, Bambi.
Hello. I don't want to belabor the Groupon topic here, but you talked about $1 billion in revenue, and I just was hoping you could clarify that. Is that revenue the fees that it generates for its merchants or from its merchants, or does it also include the revenue that its merchants is taking in? And if so, do you think that's an appropriate way to recognize revenue?
Look, I should be very careful. What I meant to say by that is we can go to the S1 of the company and look exactly what is being declared, and you can take the gross revenue or net revenue. I think the indisputable fact is the fact that this company has grown beyond any imagination compared, like whatever yardstick that you take, okay? Change the description of the revenue, fine, the numbers are smaller, it took them 3 years to get there, and maybe it's not $1 billion, it's 800 million. Like I said, I'm just a very small shareholder in the company. I don't have their financials. The reality is what I'm trying to tell you is that we can all take a different stance on it, right? We can say, oh, this is a terrible business, it's not profitable, but the fact is if you're managing that company, you can say, well, I'm going to sacrifice this incredible growth rate and I'm going to make it profitable. They can make it overnight. Or you can say, you know what, I'm just going to go crazy. This is a deck of cards, this crazy growth. Let's just pump even more money into it and grow even faster. I mean, it's just the fact that that kind of growth has not happened very often, and that's all I'm trying to indicate. And if it was only in the US, maybe we can say, okay, look, it's a unique phenomenon, but it has been replicated in so many countries that obviously there is something that the company is doing that is filling a niche, that it has been replicated around the world and it worked exactly the same way. Now, we can argue all night long and all day long, okay, it's not profitable, or good business, bad business. I'm just saying it's a very unique phenomenon.
Okay.
That was not an aggressive question. I actually like Groupon. I haven't deleted their emails.
No problem. Next question. Groupon's a great company.
I saw on VentureBeat about a month ago, there was a chart that Microsoft, Intel, and Cisco, when they went public, were all under $1 billion market cap. Now we've got LinkedIn coming out at $9 billion, Facebook, approaching $100 billion. Has the market fundamentally changed that companies are going to be worth a lot more when they IPO? Or maybe it's just a small segment that you were talking about, Bill. I'd just like to get your thoughts on this phenomenon.
So just a quick comment on that. I think you have to be very careful when you're looking at market cap, because I think a lot of the people missing, like when you look at LinkedIn's valuation and during the IPO or other things, you can actually adjust what the company is worth by controlling how much of the shares you float. If you float only a small number of shares, so on that topic, when you think about it, let's say that your public investors, you don't have any access to venture capital, you don't have any access to secondary shares. You're super bullish about technology, you want to get into Facebook and LinkedIn, you're a big believer on that. What can you buy publicly? Google is one of the few companies you can buy, but there is nothing. Then comes LinkedIn. You're just so bullish on Facebook and everything else. It's the only social networking stock available, and they're like, we're only going to make $50 million, whatever the float was. I don't know the exact number available. The price can artificially run up very, very high because you have a huge pent-up demand for that small number of stock. That doesn't mean that fundamentally reflects the value of the company. It's just a temporary play of supply and demand. So, and you have inflation and many other factors coming into play. So I just want to point that out in terms of when you're making comparisons of previous IPOs of how that worked versus today's IPOs and how they work, just kind of keep that in the background.
Anyone have a different comment?
I think it's really important. Back in when Cisco, Sun, Microsoft went public, I was at Sun when it went public. I mean, these were like 200, 250, 300 million. I think Cisco went public at $120 million. So these were smaller. The valuations were based on the numbers, the metrics, the profits, the cash flow, discounted cash flow forward stuff, because there was a lot of analysts. There was a consensus view of what the view. Now, like you say, there's few shares, there's few analysts, information is scarce, and there's a whole lot of, I think, pump up in the press. So it's a different environment entirely.
Yeah, to take a slightly different approach, though, I took my first company public in '95, and we had trailing 12-month revenues of $3 million. And there were tons of companies that, that could go public with, $5 million, $15 million, $20 million of revenue. And now at least what you're seeing is, back in the 90s, the IPOs forced the public shareholders to basically play venture capitalist because companies were going public before product market fit was established. And now, I can't speak of relative value, whether a company's worth X billion or 2X billion, but at least you have companies going public where they have generated meaningful revenue traction, where you're talking about, there's the pipeline of companies in in VC's portfolios that are generating 50, 100, 150, multiple hundreds of million in revenues that are waiting to go public is a much stronger and healthier pipeline than there was just 10 years ago.
There's another supply and demand issue here, which is the huge supply of cash on the sidelines with large growth funds that are able to make capital available readily to companies at later stages than they would have traditionally gone public, because again, going public is just another fundraising round. So if you can do a fundraising round without the brain damage that comes with the roadshow and dealing with analysts and whatnot, then that probably seems very attractive. But when you get to a $100 billion valuation and you might want to raise a significant amount of money or have sort of exit opportunities for your employees or your greedy venture capitalists, then an IPO seems like a more viable route.
Okay, we've got our next question from the question ghetto over here. I look at all the inquisitive minds.
So I was at a panel a few weeks ago. It was kind of an interesting comment. I thought I'd throw it up for you guys. The question for the audience was, is there a bubble? And one of the guys, there was a mixed review on the panels on that. There was mixed discussion. And one of the panelists was from a pretty well-established angel organization. His comment was something like, well, the new angels, not doing a lot of diligence. Every deal looks like a good deal, throwing money at it, stuff like that. So just wondering about comments. Might be controversial.
Doesn't it depend on which side of the pop you're on?
Yeah,
right? I mean,
right.
So, a bubble. It's not like it was in '98, '99 for sure. It's different. It's not as broad. Valuations are based on real stuff, not a bunch of hope and fear, I guess. So I think it is sort of very selectively, and it's a supply and demand issue. That's where the bubble comes from, not from fundamentals. I think there's some great fundamentals going on in the business. Entrepreneurs are still inventing things and doing things. So I don't think it's a widespread bubble.
For me, the question that you're really asking, or that's really being asked, is implicit in that is company X, Y, or Z overvalued? And frankly, as an individual, I don't recommend that individuals invest in individual stocks. I think you should buy index funds. You should invest broadly. We're in the business of investing in this asset class, and we invest broadly in this asset class. So is there a bubble? And you don't really know until it actually pops. But there are definitely things that are more expensive than I feel like they should be, and there are things where we feel like there's a good opportunity. But I feel like that question is probably driven around what I hear it most often: Twitter, Zynga, Facebook, Groupon. I'm probably missing one. I think I said Zynga. And who knows? In any one of those cases, I mean, we're wrong as much as we're right. So I could say yes or no, and it's meaningless. So I don't want to say that because it provides the appearance of information when it's not really.
Okay, we've got a question in the back.
Just to expand on what this gentleman, your response to this gentleman over here, that there's the big funds and then the smaller funds that have a higher batting average, if you will. If you just follow that down, then does that mean that we should trend towards smaller and smaller investments, sort of what people are giving smaller and smaller amounts to smaller companies earlier on? What's your relationship with angels and so on?
So I don't think I don't think you could extrapolate that the best funds are the funds that have $150 and write $10 checks. I live on the East Coast and I go to New York often. And when I go to New York, I have the choice of taking two trains. I could take the local or the express. They both get me to the same destination, Penn Station. And I think what tends to happen in some cases is, really large funds, they're the only thing that moves their needle is the as you said, an $80 million revenue company doesn't move their needle. So the only thing that really moves their needle is that $1 billion plus outcome, the $500 million, the big outcome. So when they invest in a company, they're kind of buying the express ticket to that $1 billion IPO, because that's kind of what their model is. And I think when a smaller fund invests, they're still aiming. When I invest in a company, I'm still, as a small fund, I'm still aiming for a $1 billion outcome. So I'm buying a ticket to the same destination. I just might be buying it on the local, so that when the doors open in Trenton or Newark and there's smoke on the train, maybe I get off, at a 25 or 100 or $200 million stop. And I kind of have the option of getting off, and given my fund size, that works for me. So now, but to be clear, no one buys a ticket for Trenton. right? No one buy. They're all going to Penn Station.
Well, not twice.
Yeah.
So, so I'm not, when I invest, I'm not investing for the $10 million or $50 million outcome. I'm investing for the same destination that the larger funds might be investing in, and I'm aiming for the same thing. I just might do it in a fund structure that gives me that's a little more forgiving and gives me a little more optionality when there's the $75 or $150 million exit along the way.
And let's be clear, there are not a lot of $1 billion plus pure early stage venture capital funds being raised right now. I don't know if Howard wants to say how big August's current fund is, but if you look at Sequoia or Kleiner, the funds that they're investing out of for their venture activities, these are not billion-dollar funds. They have
Ours is 400. Ours is 400.
So 400. Yeah. So they have multi-billions under management, which is really different than billion-dollar funds.
And also, the final other thing I'd say is that, it's hard to talk averages here because this is a business, as Ray pointed out, there are network effects that, strong portfolios and strong successes bring in other entrepreneurs, and top performing funds will continue to be top performing, whether they're 200 million or $1 billion.
You never want a little exposure to the venture industry. You want to pick the right funds, basically.
Right. Okay, we're moving into the rapid fire session. Quick questions, quick answers. Over here.
As an entrepreneur, I'm perhaps a little optimistic all the time. I ran into a friend who put a real cloud over my head and said he'd spoken with someone who was on the team for George Soros, and that there was just doom and gloom coming forward, and that I shouldn't part with any of my money or someone else's because America's going to be in for big trouble with China, India, all the emerging economies, and our sort of credit slipping and all that. So I wanted to hear a little bit of confidence from this panel.
Oh my gosh. Oh my gosh.
Quick answers.
Shall we stand up and sing the Star Spangled Banner? I mean, come on. This is America. People are copying us as fast as they can. Opportunity is everywhere. Yeah, we've got our issues, we've got our problems, but I mean, my goodness.
We're investors because we believe things are going to be worth more rather than less in the future. Betting on betting against the United States economy has almost always been a losing bet. Yeah.
To be a venture guy, you have to be an optimist.
Absolutely.
And we invest our own money in our own funds.
Yeah. And I think a great example of that, if I can just use a hard piece of data, I think 5 years ago, Europe kind of considered us dead in terms of the mobile industry. Then came the iPhone, and look at how the tables have turned, and now we have iPhone and Android, and we're world leader in mobile software. So I think in terms of fundamental innovation, there are still very few countries that can compete with the U.S. So
I don't see a lot of entrepreneurs moving out of Silicon Valley to another country. I see a lot of the reverse, though.
Okay, in the back here.
Yep. Where are you guys placing your bets? What eras are you mostly interested in right now?
Plastics.
Plastic.
Thank you, Mrs. Robinson. That's good. That's a good one. Healthcare IT.
Healthcare.
Transparency in the healthcare system is fundamental change. 17% GDP, healthcare is out of control. Obamacare can try to fix whatever. But at the end of the day, you, the consumer of healthcare, will be paying your dollars, whether it's on April 15th to the federal tax guy or out of your own pocket. But you need that information, and that is an opportunity that is just, it's so heavy it's about to fall off the tree.
Okay, next, over here.
Yeah, this is a follow-up question for that statement there. If you're a medical device company, what are you looking for? Is it just a pitch, or would it be a working prototype or a production model?
Well, I'd like you to put it in me and try it on the spot. Well, I think actually credibility of the team and the science is really important. We're early stage tech investors, whether it's healthcare or whatever. So we're looking for a lot of that sort of materials, a plan of credibility of people and technology, I'd say, would be the things.
When you're pitching for money, there's always somebody to say, well, come back when you have a prototype. And then you come back with a prototype and say, come back when you have some data.
That's a no. That's what venture capital
You go find somebody else who says, oh, that's the right fit. So I agree.
Yeah. Stay in touch means no.
Another question.
It's the truth.
Somebody tweet that. That's a good one. Yeah.
Actually, so before I ask my question, I'll mention I looked up on the S1 Groupon records it on gross, not on net. So my question is, in terms of evaluating or say an acquirer is looking at one of your companies, what metrics are they looking at besides the value of the portfolio company management team? Like looking,
the discounted value of the future cash flow. I mean, I'm sorry, it's an old-fashioned, analyst, but that's what I would look at.
I would probably differ from that. I think some of the acquisitions actually is predicated on the fact that the best acquisitions are when you have some great technology, but it's going to take a very long time to scale it. And when you look at a big company that's acquiring that small company, if you put the two and two together, for instance, like, take Cisco. I think they're very well known for their incredible sales force and reach and customer contacts, and they've been one of the best acquirers around. And so they keep finding these great technologies, and they're like, look, this technology is already there. We could probably also develop it in R&D, but they're already ahead. We have this great infrastructure. You put two and two together, you get to that huge revenue growth a lot faster. So if you can find these magical combinations where there's also good fit between the two teams of the large company and there's a good cultural fit, I think that can also have a good match. I mean, not every acquisition is just simple discounted cash flows, because some cases there are no revenues or there is some technology and very little sign of where the company is going to go, but there is definitely a good match and it does work well.
Okay, on the side.
So actually, recently there are a lot of investments coming from big bankers. How is that affecting your community in a big way? Because suddenly billions of dollars flowing into technological companies.
I don't think I've competed with a banker for an early stage venture deal. It's just they're not active in that space. I think you're thinking of late stage sort of growth or high price. Late stage is different from high price, but they sometimes get conflated. But those are the kinds of deals where we see the banks.
And one other thing to add to that is, I mean, venture business is also an access class. Just because somebody's coming in with guns blazing with billions of dollars in hand doesn't mean that they're going to do every single deal. And that's going to happen. I mean, there's still, I think, personal relationship and experience and brand that matters.
Right. Okay, next question.
I was at a meeting a couple of weeks ago with a young company, and the two partners were arguing over how much money they need and how much money a venture capital would want to look at them. The owner said, look, all I need is $10 million. And the other partner said, well, no venture capital is going to look at you for only $10 million. Is that changed? I mean, is that still...
Well, I just don't think it's true.
Yeah.
I don't think it's a matter of change. I mean, we make investments of $100,000, so many, like dozens. So.
Yeah, I think that's the average view.
I think the real question is, did he really need $10 million, or could he gotten by on 3?
I will tell you, I did a bunch of data in the mid-'90s, so it may not apply today, but I took our portfolio of about 150 tech companies and looked at Series A's. We had all this on record. And the question was asked, I stupidly asked one day, a senior partner said, so how much money does a company take? And he said, that's a really good question. Go figure that out. So I went to the files and pulled all the data and spent months going through it, building a big spreadsheet. And it turned out if you need X for your Series A, for it to be, if it's a successful outcome, you need 2.5X at the end of the day. That was the average. The Sigma was pretty big on it, but it's about 2.5 times. So if you come in asking for 10, I'm thinking, oh, much more than 10. 2.5 times 10, it's a big number fast. So don't ask for 50, I guess is the answer.
Okay, next question.
If a double bottom line company, that's a company that's planning to make money but also planning to do good in the process, do you actually evaluate those differently than any of the other deals that come your way?
I discount them. It's I'm just being honest with you. I think it's
doing
great.
good the same as do no evil?
They're slightly different, I would say. I mean, to be honest, there are sources to raise money, and in fact, I've worked with a number of people, and before I was doing this, I was working on some what you would call social investing. It's really, really hard because there's one objective measure to how a company does, and that's the value that it creates and what it's worth, and it's great when people want to do good. At the same time, those two things get mixed up and people start to go sideways. So if that's your pitch, you should be clear about that, and it's just.
And don't talk to Bill.
Yeah. I mean, there's plenty of people to raise money from that are sort of social entrepreneurs.
Next question.
So I don't know a ton about VCs, so forgive me if this question is stupid, but it seems like there's more and more angel investors coming into play, and things like Y Combinator. Does that make your job harder? Does it make it more competitive? Does it change the landscape of VCs at all?
I think it's just really exciting because you have phenomena like Y Combinator and incubators that is enticing a whole ecosystem, and there are many other I think, valid incubators like Camp and Techstars. You also have different other phenomena like AngelList that is kind of taking care of the deal flow problem for a really large number of angels. I just think that it is exciting and it is creating dynamism in the market because when I started, when I left Google and started as an angel investor, I think the ecosystem was still relatively limited. There is certainly, I would say, at least an order of magnitude more angels today, if not maybe 2 orders of magnitude. But that also means that the people that are in this business have to be that much better and that much more competitive to find interesting opportunities so that they can stand out. And I think at the end of the day, it all comes down to, of course, I think it's a great thing for more people to involve. So that means that more companies get started. There are more chances for great companies to be built. On the other hand, our job is to, whatever it is that we do and what companies we pick and, the fundamental convictions we have to stand out in the middle of the field and let the track record speak for itself.
Okay, last question in the front.
All right. I work for IBM Research here at Almaden Research Center, and there I lead a organization called SRII, Service Research Innovation Institute. And we have, in that organization, we have members, all major IT companies, HP, Microsoft, Oracle, Cisco, SAP, you name it. And our goal there is how do we take IT to the next level, make it more relevant to 7 billion people, not just 1 billion people, the way we build IT today. So it has a very aggressive and a very bigger ambition to build the IT to the next level. I have a couple of, one observation and one question. Observation is about some of the discussion about VC today and 20 billion from 100 billion went to 20 billion. The cost for a startup company has gone down significantly for many regions, cloud computing and rent, IT and so on. Secondly, I also feel that the entrepreneurs today are far more sophisticated in terms of when they go for public money, or most of them will try to do things on their own initially, and they go to VC at a somewhat a later stage than what used to be 10, 15 years ago. So that, just an observation. The question I have about this big IT and this startup, the social networking, Facebook, and sharing pictures and Twitters, and that's a lot of fun, and getting us all connected. But if you look at the world GDP, healthcare, government, education, all these things that accounts for a large part of the GDP and employment, how do we connect this phenomenon of the social networking and how you guys can help address some of the bigger issue of healthcare IT? How do we run government better? How do we run public sectors better? How do we build technology that really affects the real needs of the people, above and beyond just sharing pictures?
So that was a pretty long question, and there were probably 10 questions in there, so let me take a few quick shots. If you want to think of efficient government, go to Estonia. Everything is online. Great example of a government where everything is online. In terms of reaching masses, mobile, in fact, we've been very vocal about our focus being mobile years ago when people were underestimating mobile. This is before the smartphones started hitting really big. So I think that's a great way of doing that. In terms of how to make this transition, again, another focus area of us is education and healthcare, because when you look at fundamentally, education is going through a big change where textbook is being reinvented. And healthcare, in the sense that the point was made, I think only about 1% or less than 1% is spent on IT. I don't have to be a rocket scientist to figure out with all the craziness that number is going to have to go up. And how many entrepreneurs are going after social networking and texting companies? Hundreds. How many smart entrepreneurs are building internet and mobile companies for healthcare? Very small number, and we want to go after that very small number.
So I would say two things. I would challenge the assertion that it's less expensive to start a company. I hear this all the time, and it kind of drives me crazy. It's less expensive to start a certain kind of company if you're using Amazon Web Services and you couldn't start that kind of company 20 years ago because your market didn't exist, none of the tools existed. So, but if you want to start a company that's going to try and cure cancer, it still costs a lot of money. It might even cost more money. And I have a worry that, sort of in what Aydin was talking about, that our smartest people aren't always working on our hardest problems. Like, I think Angry Birds is really fun. I play it. It's great. But at the same time, there are a lot of important problems in the world, like helping people live longer, healthier, happier lives, solving food problems, getting sort of the right nutrition to people around the world. There's a lot of problems that are hard problems to solve that are going to take just as much money to start the next Monsanto or DuPont or what have you as it took 20, 30, or 50 years ago.
By the way, on the record, I am an Angry Birds investor. It is a wildly profitable and successful business, but I'm also like bullish on education and healthcare, so
Yeah.
I'm paying my dues on both sides.
I'll just add, you know, if you look at history, technology history, going back to the Pony Express, every time you connected people and shortened the time frame for communication, something new was built on which businesses were started. You probably don't know, Abraham Lincoln communicated with his generals in the field via the telegraph from the executive office building. It was the first use of modern communications in warfare. So the internet and the social network, the internet is just the physical piece of it, the logical piece of it. The social network is massive. It's just massive. So getting people to talk, sharing ideas, creating transparency for all the things that have been said here, that's where the value is going to be created. That's where IT will finally pay off, I think.
Well, thanks. I want to thank our panelists tonight. We got a lot of good lessons. The ones I took away were Groupon's a great company. Don't stop in Newark, and if you want good government, go to Estonia. And I want to thank our audience. You guys asked a lot of great questions tonight. And with that, I'll bring Karen back up for the wrap up.
All right. Well, on behalf of Churchill Club and our audience, I'd like to thank our speakers again and Steve, and please accept this stylish Churchill Club t-shirt as a token of our appreciation. Thanks again to Fenwick for your sponsorship, Microsoft for your hosting, and you have been a great audience. Thank you very much. Have a wonderful night and see you soon.